Everything you have seen in finance so far, the invoices, the payments, the settlements, is the cash face. Underneath it is a full double-entry ledger, and this suite is it. You rarely need to touch it day to day, because every invoice and every payment posts a journal here automatically. It exists so the books are real books, balanced, auditable, and exportable. The chart of accounts is the skeleton, every account the ledger knows, grouped as assets, liabilities, equity, income, and expenses. A new center can seed a standard chart in one click rather than building one by hand. Add your own only when you need a category the standard set does not have. Journal entries is the ledger's transaction log, every posting, in order, each one balanced with equal debits and credits. Most of these you never typed, an invoice raised, a payment taken, a purchase from the platform, each one posts its own journal automatically. Reverse unwinds a posting cleanly rather than editing history, which is the only honest way to fix a mistake in a ledger. And new entry is for the adjustments nothing else creates. This is the manual entry form, and it is the one screen in the portal that assumes you know some bookkeeping. Pick the academic year it belongs to, give it a date and a memo, the sentence that explains to a future reader why this exists, and then the lines. Every line is an account and either a debit or a credit, chosen from your chart, cash on hand, bank, tuition receivable, rent, salaries, and so on down to other expenses. Add line for as many as the entry needs. The rule the ledger will not let you break is that debits must equal credits, so a rent payment is 2 lines, rent expense debited, bank credited, and post-entry stays refused until they balance. This is the tool for the things nothing else generates, an owner's contribution, depreciation, an accrual at year-end, or the correction your accountant asks for. I am not posting this one, because a posted journal moves the books. The general ledger is the same postings organized per account. Pick an account, your fee income, say, and you see every movement that built its balance, in order. This is the view an auditor asks for when they want to know how a number came to be. The 4 reports answer the questions an owner actually asks, and the first is the one that proves you can trust the rest. The trial balance lists every account with its closing debit or credit, and the 2 columns must agree to the penny. If they do not, nothing downstream of this page means anything, so this is where an accountant starts, and where you start before you believe any other number on these screens. Profit and loss is whether the center made money this period. Income at the top, tuition, registration, everything you invoice, just under 5,000 here. Then the costs of actually running a school, and the order is the story, salaries first and by a distance, then rent, then utilities, internet, supplies, insurance, marketing. Nearly all of it is staff and premises, which is true of every school there has ever been. Take the one from the other and you have the number at the bottom, a surplus of 1,077. That is the report an owner reads every month, and the one every board meeting opens with. The balance sheet is a snapshot rather than a story, what the center owns and what it owes, at one point in time. Cash in the bank, fees parents still owe you, what you owe suppliers. And then the line worth pausing on, net income year to date, UN closed. That is the same 1,077 you just saw at the bottom of the profit and loss, carried straight into equity. UN closed means the year has not been closed yet, so the surplus is still sitting there rather than folded into retained earnings. That is what the 2 reports being one system looks like. The profit you earned is the equity you now hold, and the totals balance because of it, assets on one side, liabilities plus equity on the other, equal to the penny. And cash flow, the one that catches schools out. Profit is an opinion about timing, cash is a fact. This report shows whether money actually moved, what came in from parents, what went out to staff and suppliers, and what is left. A full order book and an empty bank account is a very survivable looking way to fail, and this page is where you see it coming. Finally, closing a financial year. Remember that UN closed surplus sitting in equity, closing the year is what moves it. It locks the period so nothing else can be posted into it, and rolls the balances forward, so this year's profit becomes next year's retained earnings and the income and expense accounts start again at 0. It is the one action here that is deliberately hard to reach and easy to get wrong, so you only do it once the accountant has signed the year off, and you preview before you commit. That is the books. If the invoices are right, the ledger is right, and these reports are what your accountant actually wants.